points of a straddle and what are the minus points of a straddle and how we can tackle the minus points. Because if you can tackle the minus points of any trade in general, if you can attack the minus points, then the trade automatically is steered into its plus points. So every trade is going to have pluses and minuses. So, and that's the reality of the options world. You're always going to have pluses and minuses. There is no free lunch, and an option strategy is always a compromise. To get something, you're going to have to give something up. So if we look at a straddle, the advantage of a straddle is it's non-directional. It can go either way. And as long as it makes a big move in either direction, your straddle is going to make money, as long as the move is more than what you pay for the straddle. So in a straddle, you're paying for a call option and you're paying for a put option at the same strike price, and the total of what you pay for both those options is your cost basis. And as long as the move is more than that cost basis in either direction, your straddle is going to make money. So let's look at a straddle, and the general case is that you should put on a straddle with at least about 60 days to expiry. But also, you have to look at the VIX levels for putting on a straddle. So if the market volatility environment is low, which means your VIX level is less than 20, then you should choose an expiry between 60 and 90 days. Because if your VIX level is low, options are going to be lower priced than if the VIX levels were higher. And if options are lower priced, then the opportunity for those options to really pump in some air into the balloon is much higher, because whenever VIX levels are less than 20, then it's a probabilistic outlook, right? Okay, so what is the probability that the VIX will remain at a level of less than 20? Well, the probability of the VIX going higher than 20 should be a little bit more than it remaining under 20. And of course, I'm making general statements here. But in general, if you have a VIX level of about 20 to 25, then you should choose an expiry of 30 to 60 days. Now, why is that? Because now you're paying a little bit more for those options, because VIX levels are 20 to 25, and so you're paying a little bit more. But as you come closer to expiry, your Vega effects reduce. So remember that your Vega effects reduce as you come closer to expiry, and therefore even when the VIX is over 25, you should choose even shorter time frame, perhaps about 30 days. Because now your Vega effects are reduced. Granted, you are in a high VIX environment, so you are going to be paying more, but the impact of Vega is going to be lesser in a 30-day option than in a 60-day option. So when volatility is low, below 20, that's when you go for a longer term expiry. And I'm talking in general about ETFs or index products like your spiders and things like that, because I'm just looking at these concepts from a broad-based market standpoint. Obviously, with individual stocks, any of these things could change. I mean, the VIX could be high, but one particular stock might have a low volatility. It's possible for sure, but I'm just talking in general terms, in broad market terms. So now the disadvantage of a straddle is, the big disadvantage is that you're going to lose time decay on both your options. So regardless of what expiry you choose and what the level of VIX is, the fact of a straddle is that you're going to lose on time decay on both your options.